Well, hello, everybody. Welcome to this week's edition of Market Insights. Steven Sitkowski here. Glad to be with you once again. We got lots to talk about, and we're sort of turning the corner in that most all of this is really good news, at least for the day, subject to change. You've been hearing me for weeks talk about the fact that, this is a news-driven market. And, the problem with that, we don't know what the news is going to be, right? There's no way of knowing in advance. We get little inklings, but most of the news is coming out of Washington. Most of it is coming from the president or the president's representatives. And, there's been a lot of back and forth. We're going to do this, now we're going to do that, quick pivots, and makes it tough for traders and investors. But when the going is good, man, you got to enjoy it. And right now, the going is good. Reminds me of that line from Zombieland when Michael Cera's character asked Woody Harrelson's character, "Hey, what do you do?" He goes, "My business is killing zombies, and business is good." In any event, quick reminder that everything that we do here is for educational and informational purposes only, should not be considered as investment advice. So, what's moving the markets? Well, this morning, I actually should have worn a green shirt. I just happen to like this color. Markets are up strongly, 2 to 3%. Why? Well, the China and the US agreed to temporary tariff cuts. Yay. Who knows how that deal is going to play out? And the key word there is temporary. But it seems like both countries want to do a deal, recognize that we are interdependent. We buy a lot of their stuff, they sell a lot of their stuff to us, take out all of the made in China products. I don't know what you'd find in a Walmart, or a Target. So, we like the idea of cheap goods. They like selling it to us. So it kind of makes sense that we put some kind of a deal together. And just the lowering of the tensions generally makes everybody feel better. Last week we put a deal in place with the UK. That is a permanent deal, much more comprehensive. So, I mean, those are two major players. And finally, these deals we've been hearing about are starting to come to fruition. Markets have regained almost all of their losses. So I think when I checked this morning, we were down year to date on the S&P 1.14%. It's basically, in my world, considered a break even. Mega tech stocks are surging. A lot of the big names, Apple, Nvidia, Microsoft, because they all do business in China. So it'd be natural. And Best Buy buys products from China. 10-year treasuries going up. And why is that? Well, the chances of a recession go down as tariffs come down. Hence, it appears though the Fed's going to be less likely to want to cut interest rates. So rates are moving up a bit. As long as they don't go up too high, we're fine. Kind of the magic number is 5%. I think it's really important that we keep the 10-year below that. Otherwise, it starts to hurt stocks. And oil prices made a jump, right? Better economy, more oil consumption. So when oil was under 60, I told all of you, could be a strategic time to get in. I know that I put on a couple of pretty significant positions in different types of trades on Chevron. Really happy that I did. Market breadth last week, you look at advancers versus decliners on the New York Stock Exchange, very positive, 1,646 to 1174. That's great. New highs versus new lows, 141 to 110. Also great. Not so much on the NASDAQ. That's tech heavy. Advancers, 2265, decliners, 2403. Not a big deficit. but new highs versus new lows, 256 to 303. So still more new lows. And that's one of the ways that you can tell, are we in a bullish or a bearish market? Now, after this week's action, that may change. I'll let you know a week from today. What to watch this week? There we go. Major economic news coming out on the week. So for today, we got the federal budget deficit. That's not going to be a market mover. Tuesday will be an interesting day. So we have the small business optimism scale coming out. Depending on when they take that survey with these tariff deals in place, that could move higher. Consumer price index, there's inflation. So it is forecasted to tick up 0.2% month over month, year over year 2.3, pretty close to, the Fed's target, core inflation 2.8. So we got a little work to do. Wednesday, all Fed speak. Thursday, a ton of data. Initial jobless claims, as always, comes out. Retail sales. How's the consumer doing? Producer price index, that's inflation at the wholesale level, is coming out. The Empire State Manufacturing Survey number will be delivered. Business inventories. So Thursday, there'll be a lot of info to digest. And then on Friday, import prices, housing starts, and consumer sentiment. And consumers feel good, they buy. When they buy, the economy thrives. So this was last week's heat map. See some nice comebacks, Tesla, Amazon, Apple, and then that's pretty much continued today as a result of all the good news I just gave you. And year to date looks much more muted still, about the same number of winners versus losers. The brighter the color, the bigger the move. So year to date Apple, that's all China. Down 16%, Tesla 21%, United Healthcare 24%, Merck 20%. We had some big losers. We also had some big gainers. Netflix up 25%, Philip Morris 37%, Palantir 54%. These were last week's, wrong, companies betting on themselves. So we have one of the best looking buybacks on record. It is estimated we may get $1 trillion of buybacks. So these are companies buying back their own stock, which is great. If you're a shareholder and the company's buying back stock, there's less outstanding shares. In other words, there's fewer people to divide the pie. So you want to see this. So that's another good indicator. Market sentiment, still kind of sucky, but improving. So when they asked independent investors, where do you think the market's going to go for the next 6 months? Those saying we think it's going to go up increased from 21% to 29%. Those saying it's going to go down decreased from 59% to 51%. We're still below historical averages. Historically, 37.5% think markets going higher, only 31% lower. So it's not like everybody is all, looking at this with rose-colored glasses. In terms of how much the rate will cut, so a month ago, we had 4 rate cuts that were forecasted for this year. Now, because good news on the economy is bad news relative to rate cuts, we have one scheduled in September, another one. The probabilities aren't super high in October, and then not again until January. So only 2 now this year. Rate cuts, of course, are good for the market. Sector returns year to date, S&P down 1.27%. 1, 2, 3, 4, 5, 6 of the 11 sectors are up. Energy, we'll call it a break even. And then we've got communication, healthcare down a little bit, tech a little more, discretionary down a little more. None are down double digits. So I remember when, and I'm sure you do too, I'd come on and tell you about, consumer discretionary down 20%, tech down 18%. Not anymore. Everything is tightened up. Let's take a look at the charts. When in doubt, always check the charts. SPX, which is the S&P 500. So I pointed out to you over the last few weeks how we had this sort of V-shaped bottom, and then we crossed above the 50-day moving average, which is bullish. The MACD turned green, which is bullish. And since then, the market's really taken off. We're back up to almost 5,800. And the average analyst has a closing price of 6,600 for this year. So I think the second half of this year might be really, really good. So the chart looks terrific. All right. So there you have it. Really nice to bring you some good news. Hope you're all out there making money, trading successfully. If you're not, we'd love to help you. But in any event, I will be back next week. Until then, be safe, be blessed. Bye for now.